Since 2020, we've seen a very slow, methodical, yet concerted effort by very sophisticated traders ranging from hedge funds, commercial banks, sovereign wealth funds, and even central banks standing for delivery. And we've seen a slow bleed down of the COMEX market, all of it going from west to east. We've seen a slow bleed down of the London bullion market going from west to east. And everyone talked about all this metal moving, to China, to Russia, to India, Saudi Arabia, to the BRICS countries, moving away from the West through de-dollarization. Of course, the weaponization of the treasury market aided that de-dollarization and in fact, supercharged it, et cetera. All of this has been well documented, right? And that's stuff that I've talked about now for, 4 years plus, going on 5. So since November of last year, some really crazy things have begun to happen. The United States, I've been doing this 35 years, and I don't remember a time where the United States has not been a net exporter of gold. And so, that was always the mantra. The West is selling all of its gold to the East, and might not ever come back, right? Since November, the United States has become a net importer of gold. Now, what happened in November? Trump won the election. Back in 2017, all those central banks were given the inside scoop and began to front run. My guess is something very similar happened this time. Right? You don't just go from net exporter to net importer for the hell of it. Something happened. And my guess is the Trump administration, who was obviously prepared for this new environment, started speaking to people that were influential, if you know what I mean. And we've seen a massive shift, from exporting gold to importing gold. Since November, somewhere in the neighborhood of 13 million ounces and 50 million ounces, 13 million ounces of gold and 50 million ounces of silver have moved from the London vaults to the United States vaults. And that's just London. Now you have, Singapore, and you have Brazil, and you have Switzerland, the refineries. You have smaller exchanges around the world where metal has been shifted into the United States. You even have some from Shanghai that is finding its way into the United States through imports. And the conventional wisdom was that it was the threat of Trump tariffs, because many of these contracts that are issued by the commercial banks on COMEX and on the LBMA are what is called rehypothecated or naked. Rehypothecated mean this same contract, if this represents a COMEX contract for 100 ounces, is sold to 20 different players.
Right.
Each one thinking they have the ability to stand for delivery. If all 20 stand for delivery, much like a fractional reserve system, if everyone goes into the bank and says, give me my money, very few will get it. Same thing with Bernie Madoff. It was a great game until everyone said, give me my money. Very few got it. And the same thing is true here. The COMEX and the LBMA are largely fractionally reserved, rehypothecated, and the majority of all of the trades are naked, meaning nothing standing behind it. And the example I gave you before using the COMEX, this means I'm not naked. Now, if I'm making that trade with nothing in my hand and going short over here, that's naked. But if I have this long in my warehouse and this short, it's covered. If I had to cover, because if I sell something short on COMEX and you buy that contract and go long, you take the other side of it. Every contract has two parties. I go short, you go long. Well, your option could be, I want my gold, thank you very much. I'm going to stand for delivery. Now, no one ever did that. But this is where the problem comes into play. And all of this gold that's been coming from London is beginning to show that. Now, London is what's called a T+1 settlement, right? T+1. And right now, they are running at a rate of roughly 6 to 8 weeks back. So how does that happen? How can an exchange that has, for example, right now, they have 280 million ounces on paper in gold. but only 36 million available for delivery, or that is called the float. The rest belong to ETFs or the Bank of England or whoever, because it's all held by the Bank of England, right? Safeguarding, and there's 280 million ounces, 36 million available against 380 million ounces in outstanding spot contracts. 380 million, but there's only 279 million there totally, but only 36 million is available. In silver, it's even worse. They have a float of 300 million. There's 800 million available. 300 million is available. 800 million is in the warehouses, in holdings. 500 of that 800 belongs to the ETFs and others. 300 million available. They say we trade 290 million a day, but they admit those numbers are 10 times understated, as they only report the final settlement numbers, according to David Jensen. Therefore, that means they're trading as much as 3 billion ounces a day, 3.5 times annual global mine supply per day. So there's 3 billion ounces on a 300 million ounce float. And in gold, as you can see, same thing. There's 380 million ounces outstanding, 36 million ounces of a float. Everyone says, give me my gold. We have a problem, Houston. And that's exactly what we've been seeing. Now they're trying to tell us at the LBMA that, it's a manpower thing. We don't have enough trucks and enough men to move it. The refining issue. And I say, bullshit. That's not how it works. The Bank of England certainly has enough capacity and wherewithal to get more trucks, even if they have to lease every truck in the UK to fill these requests. Why they could do that, right? So something is very off here. To give you an idea of how big this truly is, I don't think people understand just how big it really is, and it is very, very big. The largest delivery that the COMEX market has ever seen, was in June of 2020 during QE to infinity and the pandemic. And it was 47,132 contracts stood for delivery. Each contract's 100 ounces. So 4,713,200 ounces of gold stood for delivery. A big delivery, largest ever until February this year. The February contract just saw 59,296 contracts stand for delivery. That's 5,929,600 ounces of gold that stood for delivery. The largest by over 12,000 contracts in the history of the COMEX market. We've seen about just under 14 million ounces of silver stand for delivery as well. And when we talk about deposits, you have JP Morgan, who is delivering 4 billion in gold to the COMEX in February. One of the largest shipments ever, top 2 or 3 ever. And they have said publicly, Blythe Masters has said this many times, who used to run their trade desk, that they don't buy it for themselves. It's for a customer. Who's got 4 billion to buy gold with? Maybe Warren Buffett. He's got a lot of money in cash on the sidelines. Maybe it's the federal government, as some people think. I asked AI, I said, if the LBMA was going to fail, what would we want to look for? Signs to watch for, I said. It said widening divergence between paper and physical gold prices, indicating delivery stress. Well, at its peak about 2 weeks ago, the spread between London and the United States, I want to say, was $82 an ounce. It was $82 an ounce over COMEX premium over London spot, right? So it's saying if you have a big spread, it's about $25, $30 last time I looked. So it's supposed to just be real close so you don't get that arbitrage, right? That's one of the thoughts. Well, they're all sending it back to take care of this arbitrage. Well, could be. I guess it's convincing. I don't believe that's what it is. So the first thing they said is widening divergence between paper and physical gold prices, indicating delivery stress. Check. Then it says reports of delayed deliveries or contract settlements. T+1, no. T+8 weeks. Check. Unusual gold lease rate spikes reflecting increased borrowing costs for physical gold. Check. Major disruptions in supply chains, including mining, refining, or transportation. Well, don't have enough trucks. Refining problems because the COMEX uses kilo or 100 ounce. LBMA has 400 ounce. Got to send it to Switzerland to refine it. Bullshit. Check. And then you have the banking sector instability affecting LBMA member banks or clearinghouses. That's coming. That's the big one. So 4 of the 5 factors that AI said watch out for are flashing bright red. And so, you know, it's interesting. A couple other things worth mentioning, I guess, along the way. You know, the price of gold has moved up for 8 straight weeks, hasn't had a down week in February. And the ETFs, in particular GLD, has seen huge outflows, which to me is counterintuitive, right?
Yeah.
And the conventional wisdom, Andy, would be, well, stronger dollar, rising interest rates, profit taking, Trump trade, NVIDIA, you know. No, none of that's true at all. And in fact, if you look at the prospectus on GLD, you and I, Andy, could never take possession of the metal out of it. None of us could. You have to be like a commercial bank who has the ability to fund a basket or to take a basket, tens and tens and tens of millions of dollars. They can do it. And over the last several weeks, 16 tons, record withdrawals, have come out of GLD. That's the same thing as share redemptions. People are redeeming their shares and leaving, right? That's what the talking heads say. Or is it? No, it's an inverse share redemption by like players like JP and Goldman who take their shares privately without the visibility we would see on other exchanges like COMEX, and they redeem their shares inward, which decreases the number of shares outstanding, but they pull out the physical metal instead. The wealthy elites are removing physical from the ETFs and to consolidate control over the real assets, right? And it's always bothered me. The number of shares available to borrow have gone from 10 million to 10,000 in just a couple of weeks. That's 99+% reduction in shares. And you have a $950 million shortfall. You're talking a silver squeeze potential of historic proportions. Now, it's always bothered me that JP Morgan has been able, after paying the largest fine at that point the Justice Department ever handed out to anyone, of $920 million for manipulating the metals market, was able to retain custodianship of the world's largest silver trust. And it just seemed counterintuitive to me when you have the fox guarding the hen house.
Right.
HSBC Bank was always a custodian of GLD, but guess who's the custodian of GLD now? That's right. JP Morgan and BlackRock are now the custodians of both SLV and GLD in 2 vaults that JP Morgan holds, one in London, one in New York. They hold more gold than half the G20 countries. People have asked me, do you think gold will be confiscated again, Andy, like Roosevelt did right there? And I say, no, I think they'll take the ETFs. I've said this on 1,000 podcasts, because they can have their cake and eat it too.